All right. Well, hello there, everyone. This is Mazske Finance coming to you from South Florida. And as always, same day as it was in my earlier video today. It's still January the 28th. It's Saturday. And I have a very special guest with me today. And he's another fellow YouTuber. And he goes by Financial Firefighter. So, Financial Firefighter, aka Mark, as you are known. How are you doing today?
Good, good. Hey, Mark, thanks for having me on. Thanks for inviting me on. But yeah, it's pretty early here in Hawaii. It's 7 o'clock in the morning, but we've been trying to get this together. So this was the best time, but I'm glad to be here. Yeah, so I'm born and raised in Honolulu, Hawaii. I'm 46 years old. I've been in the fire service for 16 years now. I started my career with the Federal Fire Department of Hawaii. So that's basically the military bases here. And then finally, I was able to get into the city and county, which is the biggest department we have here. So right now I've been doing that for 14 years. Have a wonderful pension if I meet all the requirements, and we have a great retirement benefit system. But that's kind of what kind of changed my mindset down the road, and we can get into that later. But yeah, I'm glad to be here.
All right, that sounds good. And I think you know what kind of career I retired from. I'm a retired police officer. And I know I said in my video earlier today, which hasn't been uploaded yet, but and I may have told you before, I actually grew up in a firefighter's family.
Yes.
And yeah, my dad, he retired as a battalion chief in his department. And then my younger brother retired as I think a captain in his department. So they're both retired now. So, but anyway, with that being said, why don't you tell us a little bit, since you're on my channel and folks probably watch your channel, I think most folks will assume you probably own real estate and you have rental property. That's the correct assumption to make, right?
Yes, yes.
All right, sounds good. Well, if you want, tell us a little bit about what planted that seed to start investing into real estate, and then kind of lead it into where that took you.
Okay, well, it actually, I guess you could say, I've had rental properties for maybe 12, 13 years now. However, I never considered myself an investor or landlord. It was kind of, I got my foot in home ownership with a condo, a small condo in Hawaii, which is still expensive for here, but that's how I got started. And years later, I was able to use equity and finally get into a single family home, and was able to keep the condo and rent it out. But it was just kind of that stepping stone process. But I never considered myself as like a real estate investor or even a landlord. I kind of just was renting it out to a friend, and that was the process. And everything really kind of snowballed, or my mindset shifted. It really started in 2020 during COVID and the lockdowns.
Okay.
Go ahead.
Well, something I'm thinking about, because you said you're 46 years old. Is that correct?
Yes.
So 2020, that was just 3 years ago.
Yes.
And you're a firefighter. You're not like, you weren't born, say, with a silver spoon in your mouth with all kinds of money rolling in. You're just kind of like a blue collar worker. You're a firefighter.
I am. I'll definitely say I've been very fortunate. My parents have helped me tremendously. They're always helping support me and whatever needs I had. And they definitely helped me with the down payment for my first condo and whatnot. And that's kind of how it is a little bit in Hawaii. Prices are so expensive, and family members or parents have so much built up equity in their properties, and not to keep but to help their children stay in Hawaii or raise families. That's how some people get on the property ladder. So that's definitely how it happened. Definitely not a silver spoon or anything. I mean, my parents both W-2 workers. My mom was a secretary, and my dad was an engineer for the city. So he has this, we can lead into that also, but he's also in the great retirement system with a great pension and benefits. And I saw that growing up. So I was kind of, I wouldn't say I was pushed down that path, but definitely I saw the job security and, working for your pension and working for benefits and, getting a high 3 and whatnot. But I definitely saw that growing up as, kind of the comfort and security for retirement.
Okay. Yeah, it sounds pretty good then. It all makes sense. And that's really cool that in Hawaii it's like that. I didn't realize a lot of parents they would help their kids to get started. And that's really good. I'm glad to hear that. So
Yeah, I mean, if you've ever been here too, I mean, we it's kind of been restricted a little bit recently, but we were having a lot of issues with monster homes being built here, where you would find these houses that would kind of house 3 generations of families, where it'd have like, 10 to 12 bedrooms, 6, 7 bathrooms. You'd have the grandkids living in one unit, the parents and then the grandparents. So it would be this monster house that was built on lots. And that's how a lot of generations were living. And, like I said, there's a lot of permitting issues going on now. So it's kind of uh, curtailed that issue, but that was something that was going on for quite a while.
okay. Yeah, that's pretty cool then. So with all that being said, then you've been working as a firefighter and 2020 came along, we were dealing with COVID and the lockdown and whatnot, but then something happened to point you in a slightly different direction, right? Where we now become an investor.
Yes. Being a first responder was super fortunate to still be working and keep my job. And I looked around, I saw a lot of people getting laid off or losing their jobs, and how risky it was having one source of income. And even like you mentioned, you being in the police and my job, all it takes is one bad call, one injury, and you could be your income could be cut significantly, if you go on light duty or you have to retire early. And I started looking at how risky I was being with my financial situation. And like I said, I was down the path of, I'm going to work my 25 years. I'm going to get this much when I retire. I have all these benefits like medical and whatnot. And I was just coasting along. I was kind of just headed down this path, and I was just cruising along. And the lockdowns really changed my mindset. And also, I hate to always bring this up on interviews and whatnot, but me and my son's mom, was on rocky ground, and we did split up during COVID, and it was rough for a lot of people during that time. And unfortunately, we split up during that time. And one of my friends was investing in Pittsburgh at the time, and he was always telling me, hey, you should look into this, you should try this. And because I just split up with my son's mom, I was like, oh, I have all this time on my hand to kind of focus on myself and start studying other things. And I had equity in my house, in my single family home. So I said, you know what, I'm gonna look into this a little bit more. And my friend made a lot of mistakes in the beginning of his investment journey, and it definitely made me feel more comfortable because he kind of made these mistakes and was building a team and correcting it. So I was able to piggyback on it. It made me feel comfortable, like, okay, he made some mistakes, now I can kind of jump aboard on what he's doing. Kind of like how I know, like, Millennial Mike, who we both know, he did the same with you. He kind of used you as his guide, and he was watching what you were doing, and then he kind of piggybacked off of your success there. And that's kind of exactly what I did. And so I did a HELOC, I pulled out equity, and I started looking for properties in Pittsburgh. And I was going to do all cash, or actually I did all cash purchase on my first transaction. And I was planning to do a refi to pull out equity after. And during this process, things just snowballed on me. I just kind of found this new passion, and I found, like, this makes so much sense, like real estate and all the benefits, principal pay down, appreciation, cash flow, the tax benefits. So I looked at, money that I was putting into my deferred comp, also my previous employments at other places, my 401ks. And I was just like, it doesn't really grow as much as I thought it would be growing. And I didn't see a lot of these benefits that everyone else was talking about or kind of pushing you towards. And I decided that real estate was the path. And I kind of formulated a plan of how I was going to pull out the money from my retirement account so I wouldn't fall into certain tax brackets also. I didn't want to pull them all out to where I jump into, I can't remember the exact amount, but there's one tax bracket where it jumps about 9% from like 23 to 32, I believe.
Right.
But unfortunately too, I did miss the CARES Act at the time by like a month. So I did have to pay the penalties, but now that I look back on it, I think it was a smart decision based on where the market has gone and where my portfolio would have been and what I was able to acquire doing this.
Okay, that sounds pretty good. So you said you bought your first house and you pay cash for it. And then I know you've bought more property since then. So have you paid cash for any other house, or have you been getting mortgages or some other strategy?
Yeah, so ever since the first one, I also started looking as far as how to get financing. And the next few after that were in my personal name with traditional lending. And that really kind of started me to research even more, because now I started looking like, how do these other people scale when their debt to income starts becoming an issue? How do they get financing? And, especially having a property in Hawaii where our housing prices are so high, my debt to income is already kind of on the high side. And now I'm acquiring more mortgages in my name. I was just like, how do people do this? And that started me down the rabbit hole. And I started learning about like non-QM lenders and all these asset-based lenders, like the DSCR, the debt service coverage ratio. And that totally just opened up the doors for me to, as long as I'm finding these quality properties that have a certain rent amount that can cover the payment by a certain ratio, then basically you can qualify for the loan. As long as your credit score definitely affects what rate you may get. But as far as, they're not going to look at your tax returns, they're not going to look at your W-2, they're not going to look at your debt to income. It's basically just based off of the asset. And that was it. That was how I was able to scale so quickly. So now I currently have 14 single family homes in Pittsburgh.
Okay. Yeah, it sounds pretty good. So, and like the Pittsburgh market, I'm not familiar at all with that market. What price point are you more or less buying all your homes at?
So for me, I'm in the 120 to, I would say, 200,000. So like right below, kind of below the median there. At the time when I first started, a lot of these were hitting that, that 1% rule of rent to price ratio. However, prices have gone up, so the rents haven't quite kept up with that. So it's, you'd probably be looking at maybe a 0.85% to find a deal that could make it work. However, it took a little bit time to find that price range. So like going back to my friend who was investing, what actually caught me at first, I would say, is he kept talking about these like $30,000 and $50,000 properties that he was buying in the beginning. And how like the cash flow, it was almost like a 2%, like the cash, to the cost of it. And that's actually what I was like, wow, you can buy houses. And of course, he shows me the listing and they look like, oh, these are nice houses. But you don't really realize like how that neighborhood is or what the neighbor's property looks like. So he was cash flowing very well. However, the big issue that I found out was, being in Hawaii, he was trying to manage it from here, self-manage it from here in Pennsylvania. So that, that's like 6,000 something miles away, but he was trying to self-manage it. And he had contractors walk away with his money. He was having tenant issues. And so that's where he started building his team, like a property manager, certain realtors and whatnot. But what I found out was if you're in that area, it's a lot easier to self-manage it. But being so far away and trying to self-manage it, there's a lot of problems that can come up. So, and even if you have a property manager, because his properties were what you might say in the D-class neighborhood, the property management company has their own requirements for the tenants to meet. So even though he was getting a lot of applicants for his properties, they weren't necessarily meeting what the property management company's requirements were. So he was having a hard time finding tenants that would qualify from what the property management company was looking for. So that's when and it was the same time when I started buying too. So he started transitioning his portfolio in that more of that 120 to 200,000 price range.
Okay, that sounds pretty good then. So you started in 2020. We're now just kicking off 2023, and you're up to 14 rental properties.
Yes. So,
Go ahead.
yeah. So if I could just, help your audience, and I think I was to start over, I would have been better off not scaling so quickly. I think that was my biggest mistake, as I got kind of excited and I saw the gains and the process, and I saw the benefits. However, I didn't plan well with reserves, and that to me is the one thing that you kind of overlook, because maybe I was tricked. Maybe the first, I would say 5 to 6 properties were just going so smooth, like nothing, and I was just like, oh, this is easy to duplicate. And going back just a little bit, I also 1031 my condo after I started buying these properties. I 1031 my condo in Hawaii into properties in Pittsburgh, because I just looked at how much cash flow I was making on my property here, and I was just like, I can get this amount of properties in Pittsburgh. So I also did that. And, like I said, I didn't plan well for reserves. It probably would have been better if I stopped maybe around 8 and kind of let things get stabilized first. Because I also got a lot of properties during the winter time, which I found a lot of good deals. However, as I'm not too aware of the winter months, the weathers, and how difficult it is, but it took a lot longer to find tenants than I was anticipating. So that was another little hiccup in the process. But so even though I found great deals, I probably lost a lot of that, benefits that I got from finding these great deals, because I had these properties sitting vacant a little bit longer than I thought. And that's the one thing, is if you have a stable portfolio already, it is a little bit easier to scale quicker, or maybe take a little more risk. But because my portfolio was so new, it's kind of hard to get maybe 10 to 12 properties stabilized at one time. And that's probably what has slowed me down, and probably my biggest mistake, and what I would probably change if I was to start over.
Right. I understand completely there, because, as you know, I in my YouTube channel, I talk about, I probably say it too often, but I went from 0 to 25 rentals in 4 years. And I never want people to take me the wrong way, like, oh, wow, I don't want people thinking, wow, Mazske, you did so well. Because I've made a lot of mistakes myself. I've tried to share my mistakes on my channel. But sometimes I think people gloss over my mistakes and they fixate on 0 to 25. But my biggest mistake has also been not having enough reserves, because as I grew, I had very few problems in the beginning. Then I got more units. And then I started having to do rehabs, and rehabs used to cost me $6,000, $7,000, $8,000. Now they're costing me $19,000, $20,000. And if you're a little low on reserves and you're counting on them costing 10 grand or less, and now you start getting them in their 20 grand, you better ramp up your reserves. But if you're rehabbing and spending your money, it's hard to do.
Yes. The one thing that I would say, though, is being in Hawaii, I was quite glad to actually hear the cost of the rehabs in Pittsburgh compared to doing something like that would have been done in Hawaii. Like when I first found out I had to fix these things or do certain things, I was just like, oh, it's gonna cost this much money. And then when I get the quote back, I'm actually quite surprised. I'm like, is that it? Like in Hawaii, it'd be like 3 times as much that cost. So that was, I mean, yes, it was hard to, stomach, but at the same time, I was quite relieved when I actually saw the quotes.
Right. Yeah, it makes sense because as I've said on my channel, I've moved in the last 2 years, I've moved to South Florida. And like this market I'm in now, it's making the national news, I think, because it's one of the fastest growing, out of control real estate markets in the country, I believe. They rank #1 in one of those categories. But when I compare this market to Virginia or to my market of investing up in Indiana, in Virginia, I'll give you an example. I put 2 roofs on 2 different houses in Virginia. One house was $4,000, one house was $5,000. I put roofs on houses in Indiana going back 2 years ago, $6,000, $7,000, $8,000. Here in South Florida, when I had the hurricane and I didn't need a new roof, but I asked different roofing companies, what would my roof cost? And I have a tile roof. And they threw out a number that's $60,000. And then I look at folks who have shingle roofs. They're paying $25,000. Metal roofs might be $35,000 to $40,000. And I'm like, wow, not only did I move to a market where housing prices are going up, if I do need to rehab this house, I'm looking at some major, major bucks to do that.
Wow. Yeah, that's kind of surprising for in Florida, I guess, like the cost. Is it?
It's well, I think it's supply and demand. We did take almost a direct hit from the hurricane. There was already a housing shortage, and now I've seen numbers from 5,000 houses completely gone and upwards of 25,000 houses, like if not gone, severely damaged. So there's an even greater lack of housing inventory, and contractors who were already busy pre-hurricane. And I'll give you a quick example because this video is supposed to be about you, not about me. But a quick example, I have a fence here that I installed, a privacy fence. It's a vinyl privacy fence. It got damaged by the hurricane. My fence guy, when I contacted him, said he'd be out when he gets an opportunity to give me an estimate. He came out, he gave me the estimate, and he told me it would be 2 months or 3 months till he could get to my fence. And I said, well, that's fine. I said, I'm just curious, how many fences are you up to now that you have to repair? And he said, you're in the top 1,000 fences and the list is still growing.
Oh.
And it's like, no wonder it's going to take several months, because that's not normal to have one company in a market that might have 20 companies has 1,000+ fences to repair.
Yeah.
And
Wow.
roofs are the same. There's thousands of roofs that need to be fixed and or repaired, and contractors, supply and demand, they're in demand and their prices have gone up.
Wow.
So anyway, that's enough said on that.
Yeah.
Yep. Well, cool. All right. So here's another question for you. You're 46 years old. You have 14 rental properties. I think you mentioned you don't have too much longer to work to get that pension. Is that correct?
Well, if I want my maximum benefits, I would have to do 10 more years around.
10 more years.
Okay. Yeah. I mean, I could retire now and get a certain amount of my pension and medical coverage. But if I want the full, it would be 10 more years. And as you know, you probably mentioned on your channel, Millennial Mike, it's not a young man's job. And I'm really starting to notice that. And I mean, I work out consistently. I love working out, but it's you're fighting father time. I mean, there's only so much you can do. And I definitely started playing in my head, like, it just takes one bad call or one bad mistake. And part of it too is I don't want to become a burden for my son as I get older. And I want to make sure that my passive income or my wealth is enough to sustain whatever I need to do, or if I have to go in a care home as I get older. And I don't want to affect his life, whatever life he's living. Maybe he moves to the mainland, or maybe I'm still here. And if I have to go in a home, I wouldn't want him to have to change what he's doing and worry about how I'm going to be taken care of. So that's where my mindset also shifted. And that's also why my plan is to retire early. I want to get out early because I also feel like I can do a lot more in real estate. So also during this process, I also got my real estate license. So I'm with Remax Honolulu, and I see that as something that I can do 20 more years if I want to, or I can do it like referral based. So right now I'm just trying to build up my brand while the market is a lot slower. And I just feel like this is also something that there's opportunities everywhere. Like I could, I probably, when I do retire, I'll probably retire in North Carolina or South Carolina. I love it there. That's where my son's mom's from. And I just love that area. And I'll probably snowbird back and forth. But definitely, I just feel real estate you can do anywhere. And it just provides so much opportunities. So I may do 10 more years, but I really don't see it. And part of that too is I want to get out early for kind of a proof of concept. Because I'm trying to help a lot of the younger guys realize that you don't need to work 25 years to get a certain income level, or that shouldn't be your goal. Your goal shouldn't be to work 25, 30 years and work off of 50% of your income, basically on a fixed income. And you probably are aware of this too, but the pension is not what it used to be. So the younger guys, their pension is not the same. So even my pension is not the same as guys that got in maybe 5 to 10 years before me. And so now even the younger guys that are coming in after me, their pension isn't as beneficial. They have to do a lot more things to get a certain amount, and even their payouts are a lot lower. So I'm just trying to get a lot of the younger guys to start thinking like, hey, you guys need to start planning for your future, because you're going to be on a fixed income when you retire. If you just rely on your pension, they have to pay for medical. Now their medical is not covered when they retire. Like for me, if I hit a certain years, I'll get a certain percentage, and if I do the 25, I'll get 100%. But the newer guys come in, I mean, they got to take care of the medical on their own. Their overtime pay doesn't count towards their high 3 salary, and even that, so theirs is a high 5, so based off of their 5 highest years, their percentage. So their pension plan is just getting reduced. And I'm just trying to help the younger guys realize that there's other things that they can do to plan for their future. And so I feel like if I can retire early, it just kind of gives me more power as far as saying, see, I did it and I got out early. And kind of that's where this whole like the social media and building my YouTube channel, and it's just trying to help people get started. And I think that's one of the biggest problems, especially in Hawaii. Like just, I want to say in December, our median single family home price was 1.1, I want to say, was the single family home median. And for a lot of people, it looks so out of reach for them, trying to figure out how they're going to purchase their first home. And especially if they do a 20% down, and a lot of times you're saving how many years to get that 20%. And by the time you get there, the property is appreciated another 10 to 15%. So now you're always playing catch up, trying to save that money. And that's why I feel like out of state investing is so helpful, especially if you live in an area that the housing prices are so high.
All right, I agree 100%. Because I know I've said on my channel, if I had just done like a lot of my peers in my job and retired just to my pension, I would not be living in South Florida. I'd still be in Virginia, and I probably would be working a full-time job up there because my pension is not enough to live on. And then you combine it with a year ago, inflation was running close to 10%. My pension got a cost of living raise of like 1.7%. That's that's a
Yeah.
losing game,
Yeah, exactly.
right? So anyway, with that being said, where do you, in regards to say rental properties and investing in real estate, over the next 3 to 5 years and even beyond, where do you see yourself heading, going in with real estate? Do you see yourself ramping up more single family homes? Do you want to get into multifamily? Do you want to get into commercial property, or what do you think?
That's a good question. I mean, that's the one thing about real estate. There's so many strategies that you can use, and sometimes, it's kind of like that shiny object syndrome. Right now, well, up until now, Airbnb, short-term rentals was super, super hot. Multifamily is super popular right now. And I don't know, I just, for me personally, I like the single family homes. I like that space. I like, so some on Twitter, actually, somebody just posted something today. They were asking about, as far as, would you partner with people, take private money to do deals? And, for me, I like the space I'm in. I like owning the property, 100% ownership, not partnering with anyone else, not having to take private money or hard lending money. So for me personally, I like the single family space. I see it as kind of a, everyone needs a place to live. It was kind of a simple process. You have more exit strategies where, you can sell to investors, you can sell to homeowner or first time home buyers. So I like that space. I think if I was, I mean, I'll probably stay in that 1 to 4 range, or if I do go to multifamily, it'll be in that smaller range where I'm not dealing with the big institutional players, and I'm not going to be also maybe with the newbie investors. So kind of that space where it's kind of not a real, I think, market that a lot of people are in right now. They're either going real big into the bigger multifamilies, or there's a lot of new investors staying in the single families. So there's that little maybe 5 to 20 multifamily space where I'm kind of interested in. But right now, just single family homes. I'm also in one syndication as a limited partner with my mastermind group, and I definitely see syndications as a really good end game. Like, it's definitely passive if you're looking for something where you're going to be traveling the world, and you just don't, you don't want to be worrying about things, and you just want this residual income or the 2x payout at the end. I definitely see syndications as a great end game to kind of put your money in, have it multiply. However, for me, where I'm at, I need that cash flow to grow and scale quicker. So for me, I like that monthly cash flow income from the rentals, and I just learn a lot more. The syndications are great, but it's super hands off, and you just don't learn as much, I feel. Once you read the pro forma and you kind of get an idea if it's a good deal or you're going to partake in it, after that, you're pretty much just hands off. You wire the money, and now you're just waiting for the returns. Where the single family homes, I just feel like there was so much learning involved, from the lending side to property management, to finding the property, like with the realtors, and just, even taxes. You're a little more involved with the taxes, and trying to run it like a business with whatever software or company you're going to use for your bookkeeping. But it's just so much learning, and I get it. For some people that might be too much, and that's why the syndication route might be better for them. But for me, I mean, the single family route, I just feel like there's just so much to learn, and it's super, super helpful.
All right. All right, that makes complete sense to me. And I know you watch my channel some, and if you check my playlist, I call it Interview with Others, you'll find I had a talk with a lady named April Crosley. April has her own YouTube channel, and April started off flipping houses. She got into buy and hold real estate. But
In Pennsylvania, right? In Pennsylvania, right?
Yes, in Pennsylvania. Yep. But she now, and I think she said in the talk with me, or we talked off camera as well, she is really into syndications now for that same reason. She got fully involved with real estate. She learned a ton. She's teaching other people. But she spent, I think, a year or two traveling the country in an RV, and she just wanted to step back a little bit, and syndications was the direction she went into. Then I've talked a little bit about myself. I didn't do it for that reason necessarily, but I kind of switched gears a bit and went in the energy direction with oil drilling and mineral rights acreage. They're kind of like syndication, but they're different. And it's independent of real estate, so it's passive income, completely hands off. Just a check comes each month with a potentially a 2x, 3x, 4x return at the end. And I kind of like that, especially with me planning to make a move outside of the US. I still want to keep my rental properties. I still want to grow more rental properties, but I want to kind of diversify a bit into a different field as well, just to be safe, because I'm living off my investments.
Yeah.
So that's kind of what I'm doing.
Yeah.
All right, cool. All right, well, that sounds good. Tell you what, we should probably wrap this up. We've been on here a while, and I got a busy afternoon ahead of me. So, but it's been great talking to you. If you can, like I was telling you in the beginning, I got my Zoom's been updated on me. My buttons are different. Normally when I stop recording, we'll stay connected. If we do stay connected, we'll chit chat a little bit. If I lose you, I'll shoot you a text.
No problem. Thank you for having me on.
All right. Thanks so much for being here, and have yourself a great day and enjoy that beautiful weather in Hawaii.
Thank you. You too.
All right. Take care. See you now. And everyone, thanks so much for watching. This is Mazske Finance and Financial Firefighter. We are signing out.